This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode 65 was recorded on September 30th, 2019. I'm Eric Townsend. All-star Luke Gromen, founder of Forest for the Trees, is back with us today. This episode of Macro Voices is brought to you by TopTradersUnplugged.com, which happens to be my favorite podcast when it comes to quant and rules-based investing. Check them out. You'll be glad you did. Luke, what's got your attention this week?
Yeah, hey, Eric, what's caught my attention recently, or what we think is the marked acceleration of the failure of a narrative that is critically important to a wide array of markets and assets.
Okay, I'll bite. A failure of what narrative specifically?
You know, when narratives fail, to the casual observer, the failure seems sudden and out of the blue, but there's usually unmistakable signs of narrative breakdown that often become obvious to most observers, really only in hindsight. And one of the most dramatic stories of a failed narrative that we've ever read comes from Barton Biggs, the former Morgan Stanley strategist, in his book, Wealth-Worn Wisdom. And if I may, I'm just going to read a quick excerpt here. The Japanese official battle reports and the Japanese press reported the Battle of the Coral Sea as a great triumph, and Midway was portrayed as a victory, not a defeat, although some loss of aircraft and ships were admitted. Although casualties must have been noted and grieved, Japanese society at the time was so united behind the war policy and believed so totally in the invincibility of the Japanese military that defeat and economic failure were virtually inconceivable. It would have been unpatriotic to sell stocks. Not every investor in Japan misread the battles at Coral Sea and Midway. Food was in short supply, and railings in the parks around the Imperial Palace were being dismantled for their iron. The Nomura family and Nomura Securities in mid-1942 began to suspect the eventual defeat of Japan. Although the newspapers and radio broadcast only good news about the course of the war, the Nomuras apparently picked up information in the elite tea houses of the upper class. Many of the naval officers and aviators involved in the battles at Midway and the Coral Sea had geishas, and when the officers failed to return, rumors began to circulate. The Nomura family, sensing something was amiss, began to sell its equity holdings gradually and even sold short. Later, they purchased real assets, probably reasoning that land and real businesses would be the best stores of value in a conquered country. These protected assets allowed the family to have the capital to finance the rapid expansion of Nomura Securities and Research in the immediate post-war years and eventually emerge as the dominant securities firm in Japan. And so this excerpt I thought was really interesting because while the Nomura family recognized the symptoms of narrative failure earlier than most and then acted on them to their great and lasting benefit, but they were really the minority of people that did so in Japan. And when you look back, you have to ask, when did the Japanese government narrative that they were beating the U.S. in World War II officially fail, or, quote, officially fail? And many date it to August 15th, 1945, which was 6 days after the second atomic bomb was dropped on Nagasaki, when Emperor Hirohito addressed Japan on the radio to announce Japan's surrender, noting, quote, the war situation has developed not necessarily to Japan's advantage. And now, I suspect Barton Biggs has simplified the story for the ease of retelling and for the message, but I think it might be an instructive metaphor for investors going forward.
So the real problem, you're saying, is that in the absence of geishas, we don't have the leading indicators that we need. So how do we relate this story to today?
Right, exactly. We found that it's easy to get caught up in day-to-day movements and not see the bigger picture. It's why we started our firm. It's why we named our firm Forest for the Trees. And at certain key tipping points, it pays to take a step back and try to see the forest for the trees. And so where we're going with this is we think the repo spike from 2 weeks ago is one of those moments. What happened with the repo spike reminds us a bit of when those two subprime mortgage hedge funds went to zero basically overnight in the summer of 2007. And at the time, most everyone said, whoa, what was that? For a little bit, but then most investors sort of went back to the prevailing narrative. And so to directly answer your question, how does Biggs' story about Japan during World War II relate to today? We think the repo spike is similar to the Japanese government dismantling the railings in the parks around the Imperial Palace for iron. And to your point on geishas, we don't have them, but basically it's akin to geishas reporting that naval officers were not returning home from battles in which the Japanese had supposedly defeated the U.S.
Okay, in what ways specifically does this relate to geishas?
So, if we go back to this time last year, overwhelming consensus was the Fed was still going to hike 1 to 2 more times in 2018, 2 to 3 times in 2019. The Fed was still a long way from neutral, and the rest of the world was going to break way before the US. And of course, as we've noted many times in early 4Q18, FX hedge treasury yields went negative. That was a really big moment, and that contributed to the first sign of the failure of this narrative. In 4Q18, U.S. equities plummeted. And so if the first sign of this narrative failure was 4Q18's risk asset sell-off, the second sign was the Fed backing off on rate hikes. And then a big sign of narrative failure, which, as again we've said a number of times, was Fed funds going above IOER back on March 20th, 2018. And back then, consensus was Fed funds over IOER was, quote, just a temporary technical issue. It was related to quarter-end issues and tax payments, which is remarkably similar to what we're hearing now, and that the Fed had the tools to deploy to address this at any rate. And as we've noted repeatedly on Macro Voices, we said that Fed funds over IOER was anything but temporary or technical, but was instead a function of too much Treasury issuance versus not enough foreign private sector demand for Treasuries with where the dollar is trading. And 2 IOER cuts and 2 Fed funds rates cuts later, Fed funds rate has remained above IOER for every single trading day since March 20th. And so to us, this was another big sign of narrative failure, akin to food being in short supply in the big story, except this was dollars being in short supply in the U.S.'s own banking system.
Okay, that's interesting. So with this background, how do we carry this metaphor into interpreting what the repo rate spike is actually going to mean for markets and what comes next?
Sure. So, the narrative of, the U.S. is in the strongest position vis-a-vis a dollar shortage and will break last was already well into failing when 2 weeks ago we saw repo rate spike from 2% to as high as 10%, which forced the Fed to implement first a temporary repo facility. Then we saw them extend that for an additional several days. Then we saw them open several term repo facilities. Then they announced repo would stay open until October 10. And to us, this is like the Battle of Midway being portrayed by the Japanese government as a victory over the U.S., while the Nomura family was hearing from those officers of geishas that the naval officers in charge of many of the ships at the battle weren't returning home. And so, the repo spike in the U.S. meant that the dollar shortage in the U.S.'s own banking system, caused by too much Treasury issuance and not enough foreign private sector demand for Treasuries with the dollar valued this high, had gotten critical. And this was a big narrative failure, a huge clue on its own. But the repo spike also gave us a secondary narrative failure within the Fed's response to it.
Okay, what do you mean a secondary narrative failure in the Fed's response?
Well, as best we can tell, implied in the sort of the strong dollar will break the U.S. last, long after it breaks the rest of the world narrative, was the belief that when push came to shove, the Fed would let the world effectively twist in the wind, which would drive a dollar super spike. Unfortunately, nowhere in that narrative was the expectation that the break would come in U.S. money markets. So when push did come to shove, as it did 2 weeks ago in repo, the Fed did not let U.S. money markets twist in the wind. In fact, they responded within 12 to 24 hours, and then they kept responding.
Okay, Luke, so it sounds like you don't agree with Jay Powell's narrative, which is, hey, the repo spike was just a temporary technical phenomenon. Nothing to see here.
No, we don't. And clearly, there were some short-term forcing factors. You had some quarter-end regulatory capital needs, window dressing, the Treasury increasing balance in the TGA. And it was even what I thought were interesting and probably credible stories that the attacks on Saudi oil facilities forced a Saudi withdrawal of dollar liquidity when markets reopened Sunday night and into Monday and Tuesday of 2 weeks ago. But really, those factors really, if anything, just merely accelerated a trend we've repeatedly highlighted over the past 5 months, which is this too much Treasury supply versus not enough foreign private Treasury demand because the dollar is too high.
Well, I agree with you, Luke, that people tend to dismiss these things when they shouldn't. I remember early in the 2008 crisis, I think before Lehman, the TED spread started blowing up, and everybody said, oh, but we don't have a good explanation for why that's happening, so therefore it's safe to ignore it. No worries. So earlier this year, you said Fed funds going over IOER you thought was not temporary. Are you thereby, or are you now saying that the repo spike and the Fed's response is also not likely to be temporary?
Yeah, I think the Fed's response to the repo rate spike, and again, Jeff Snyder had a great point last week where he said there's ebbs and flows to liquidity within a quarter and throughout the year. But sort of setting that aside, I think the Fed's response to the repo rate spike is likely to be anything but temporary because the underlying cause is this too much treasury supply, not enough foreign private sector demand for treasuries with the dollar trading as high as it is. And so Treasury issuance is not going to stop anytime soon because U.S. deficits are not going to stop anytime soon. I mean, unless the U.S. is going to slash entitlement spending for 70 million baby boomers in an election year, or we're going to slash defense spending in the middle of a trade war, or somehow eliminate U.S. interest expense paid on treasuries.
Okay, if that's the case, how long do you think that the Fed's response will last?
You know, we said to someone the other day to borrow a phrase from the band Outkast in their song Miss Jackson. It's forever, forever, ever, forever, ever. And while I joke about it, this is the big narrative failure that we think is still on the come in our view. Because the real underlying cause of the repo rate spike is too much treasury supply, not enough foreign private sector demand because the dollar's too high, and with U.S. deficits never stopping, the answer to how long will the Fed response last is either until the U.S. stops running deficits or the U.S. dollar falls enough, or to paraphrase, for the foreseeable future or until the U.S. dollar falls enough. And so, to continue the Biggs Japan metaphor, we think when it comes, investors' broad realization of this reality is akin to the nuclear bombs hitting Hiroshima and Nagasaki and to the emperor surrendering. The evidence that the war wasn't going well for Japan was there for anyone to see, but only a few saw it. And similarly, the evidence that the dollar shortage is not going so well for the US government and money markets has been there for 12 months plus for those with the eyes to see it, but a relative minority see it for what it is and what's now begun.
Okay, Luke, for the benefit of those who aren't seeing it fully, what specifically are we talking about?
We think that Bank of America's Mark Cabana, who's one of the foremost experts on the monetary plumbing in the U.S., said it best 2 weeks ago when he was interviewed by CNN when he said, and here's the quote, "The Fed won't admit this, but it looks and smells an awful lot like the monetary authority is financing the fiscal authority." The repo rate spike and the Fed's response to it, given the underlying cause of the repo rate spike, mean that the Fed has now effectively been forced into financing the U.S. government through the money markets for the foreseeable future, or until the dollar weakens enough to restore the foreign private sector bid for treasuries to full strength, which would occur via a normalization of FX hedging costs and FX hedging markets.
Luke, why do you think the Fed hasn't said anything explicitly about this whole issue?
It's a great question, right? What are they going to say? We've been forced by a president we hate into ending our independence to effectively finance the U.S. government through the money markets. There's no sort of happy way to spin that. And so we began saying 5 months ago that soon the Fed would be forced to choose to either lose control of the price of money in the U.S. or lose control over the quantity of money in the U.S. And, at the time, there was, we took some flack for saying, oh, the Fed would never lose control of the price of money over the U.S. Well, the repo rate spike was the Fed losing control of the price of money in the U.S. And as we said at the time and strongly suspected and continue to strongly suspect, when push came to shove, the Fed would choose to cede control over the quantity of money in order to control the price of money. And that's what they chose because controlling the price of money is the Fed's only reason to exist. And this is fine, but what it means from here is that the only thing the Fed has control over anymore really is the narrative, and they're trying. To their credit, they're trying, right? So it's just technical factors, it's just temporary, it's just organic balance sheet expansion. It's not QE. They're trying to spin, what markets will soon realize is unspinnable. The Fed will now effectively have to finance the U.S. government until the dollar falls sharply enough to restore the foreign private sector bid for treasuries back to full strength.
Okay, Luke, let's translate this to actual portfolio positioning. How are you positioned for the view that you now have?
Sure. So, investors have a choice. In the short run, where the dollar shortage is and where it's acute really doesn't matter. It's a dollar shortage. What has become an acute dollar shortage in the U.S.'s own banking system will drive the dollar up just as well as a foreign shortage would. The difference, in our view, is in the Fed's response time and how long it takes until the quote unquote nukes of investor realization about what's happening here hit the markets. And, our view is that the repo rate spike at 2 weeks ago and the Fed's response, I mean, those, quote unquote nukes are now inbound. So while the dollar could continue to strengthen for a bit, the more it strengthens, the worse the dollar shortage in the U.S.'s own banking system will get. And so at the very least, our view is that the runway on dollar strength was meaningfully shortened by the repo rate spike and the Fed's response and the duration of the Fed's response. And, at the very most, the nuke of market realization that the Fed is now committed to effectively financing the U.S. government until the dollar falls enough, that nuke is now inbound. And one wants to be short dollars and long gold, silver, U.S. value assets, probably European assets and EM assets when that nuke of realization hits the market. So our view in terms of the choice investors face is what's the duration of dollar strength from here if these nukes are inbound? And we think that can be answered by the question is, when will a quorum of market participants realize that what the Fed has basically been entrapped into doing for the foreseeable future or until the dollar falls?
Some people would say that the Fed doesn't have enough firepower to deal with this. We've heard this quite a bit. The Fed's out of bullets is the phrase that you hear a lot. Would you agree with that view?
No, not at all. Fed's got plenty of firepower. They've got a printing press, as Ben Bernanke told us all in '02, and they have an infinite balance sheet because when they create currency, they simultaneously create both an asset and a liability, which means, they can expand their balance sheet as much as they need. And the thing that I think is people are having a hard time getting their minds around is that the Fed's going to soon have to start doing exactly that.
Okay, so you don't think that they need political cover to do that?
I do think they need political cover to do that. That's certainly something we've talked about in the past. But what I really am beginning to think is that many investors are fighting the last war, so to speak, when it comes to political cover for the Fed in order, for them to have the cover to act. And what I mean by that is most investors are waiting for equity markets to tank to provide the Fed their political cover when, to me, the increasing reality is the political cover may very well have happened 2 weeks ago when repo spiked to 10%. That may be all the political cover the Fed needs. I mean, U.S. primary dealers effectively saying, look, if you don't get repo rates back down, our repo funding costs of 8 to 10% will soon force Treasury rates to start moving towards 8 to 10%. That's an existential threat to the U.S. government's ability to fund itself and to the global economy. So, we think the political cover may already be there. And so we remain positioned as we have. I mean, the Fed took 12 to 24 hours to respond to the repo spike. And, given how important equities are to driving U.S. consumption and U.S. tax receipts with equity market cap at 155% of GDP, we think the Fed's response time to a sharp drop in equity prices would probably be only marginally longer than their 12 to 24 hour response time it took them to respond to repo. So, I will say that as it relates to gold, I do think it's worth noting that if the long end of the yield curve begins to back up, as we think it might, as investors realize what the Fed's been forced into, one could see some short-term weakness in gold and silver prices as real rates rise a bit. But in the near term, this could be tradable. But for investors, we would buy aggressively into such weaknesses because, what's really now begun is, we think, a perfect positive storm for gold, silver, et cetera. So.
Luke, I'd like to try to take your view of a narrative failure and sort of map it into a similar view that I've been developing, which is, it feels to me, as you say, the monetary policy is the solution to all problems. That narrative is failing, and we see that in so many different ways. But I was just reading Eric Peters' weekend notes this morning because I've got him coming on Thursday evening for our feature interview. And he's writing about his expectation, and I agree with him, although I think I have different reasons than he has, of there being kind of a passing of the baton from monetary policy being what it's all about to fiscal policy really being the governing factor. Essentially that the monetary policy narrative is failing, and now there's got to be greater fiscal initiative. And the way that I translate this is, I think in an election year, it's going to be just incredibly contentious about what the fiscal action should be. And I think there's going to be polarized views on different sides of the aisle, and it's going to create a lot of uncertainty for markets and potentially a lot of turbulence. And if you think about it, if you're the Democrats and you know that you've got a view that's at odds with the current establishment, and the risk of pushing your view really hard is that it could crash markets. Well, it's a time when you don't mind crashing markets because it's only going to hurt the president's chance of being reelected if that happens. So it seems to me like the ingredients are there for this narrative failure to just fuel a hugely contentious election season. I'm just curious if you have any feedback on that or perspective.
Yeah, I think it's a fair point in terms of just the volatility around that and that narrative. I mean, you've seen the narrative on fiscal shift pretty quickly. I think we talked to either last time we were on or a couple times ago about this white paper put out by the BlackRock Institute, authored by former Fed Vice Chair Stan Fisher and Philip Hildebrand from the Swiss National Bank and Jean Boivin from the Bank of Canada, and it's like a roadmap of basically, here's, in the next crisis we are going to need to do MMT, and we are going to need to cap bond yields and basically lock in real losses to long-term bondholders. And here's the roadmap by region of the world, what we need to do to accomplish that. So I think that makes a lot of sense. The wild card within all of that to me is, and again, this speaks to why I think the importance of repo having done what it did, and the fact that it was repo, right? So repo is basically, you take repo to 8 to 10%, and even if you move it up like half that or less than half that, what you're really doing is effectively standing on the oxygen hose of a critical patient in the hospital, right? So the reason I say it is I think we will get this volatility around stimulus, fiscal, the political tension that you were describing. Where I begin to wonder is we have this critical patient and whose oxygen hose is being stepped on. And so people say, is the trigger the November 2020 election as we get closer to that? And it could very well be. But with repo having done what it has done, with the economy slowing, you're really looking at, I don't know that we have nearly that much time, again, because it's effectively the oxygen hose to the entire system that's being stood on potentially. So I think because it's repo, because it was as pronounced as it is, because the deficits aren't going to get any better, I think the forcing function is going to get much messier. It's going to force decisions that maybe don't want to be made or would rather be put off till after the election, well before the election.
Well, Luke, thanks so much for a fantastic interview. We look forward to getting you back in a couple of weeks for another update. This episode was made possible by TopTradersUnplugged.com, my favorite podcast when it comes to quant and rules-based investing. And remember to head over and listen to my conversation with its host, Neil Kastrup-Larson, which we released on September 7th, 2019. To get the slide deck that Neil shared, head over to TopTradersUnplugged.com/macro slides. And as a listener of my show, you're also able to get his latest book for free by going to TopTradersUnplugged.com/macro. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.